The headline you're being fed is that Russia's oil is crashing because prices are down. That's the kindergarten version. It's the kind of story that makes people argue about charts while the adults quietly renegotiate the plumbing of the global economy. Because the real event isn't oil fell. Oil always falls. Oil always rises. That's the spectacle. The real story is that Russia's oil system is being forced by sanctions architecture, shipping logistics, and refinery math into a worse business model at the worst possible moment. Not less money, worse margins, worse customers, worse leverage. And once you understand that, you stop asking, will prices recover? And you start asking the only question that matters. Can Russia still convert barrels into power? Here's the hidden resource in this story. Not oil itself, the ability to monetize oil at scale through Western financial and maritime infrastructure. That's the resource being fought over. The West doesn't need to stop Russian oil. It needs to degrade Russia's conversion rate, turning a barrel of crude from a clean financial instrument into a discounted, risky, hard-to-move physical liability. And Russia's response hasn't been heroic. It's been transactional. Russia built a workaround, shadow shipping, alternative insurance, new buyers in Asia, new payment rails. It didn't beat sanctions. It paid a toll to keep exporting. The toll is hidden in discounts, freight costs, middlemen fees, longer routes, and a dependency on a narrow buyer cartel that knows Russia has limited options. So when you hear Russia's oil crash, don't picture a simple price dip. Picture a commodity superpower being slowly shoved into the role of a distressed seller, like a landlord who still owns the building, but can only collect rent in a currency nobody wants, through tenants who demand a discount using an elevator that breaks every week. This isn't about prices. This is about control of trade lanes, control of insurance, control of settlement, and ultimately control of the terms of energy. And those terms are now being rewritten in real time. Let me show you the numbers, because geopolitics is just accounting with weapons. Start with the obvious. Russia is one of the world's top crude exporters. Even after the post-2022 reshuffling, exports didn't vanish, they rerouted. The new dependency structure matters. Russia's export machine now leans heavily on a narrow set of Asian buyers that can dictate terms. That is not pivoting to Asia. That is bargaining power moving away from Moscow. Now look at the choke point the West designed, the price cap. It was never a moral gesture, it was a market mechanism. The goal wasn't to remove Russian oil from supply, it was to keep supply flowing while clipping Russia's revenue and forcing it into less efficient channels. In other words, keep the world calm, keep Russia poorer. And it worked, partially, because maritime trade runs on services: insurance, brokering, classification, finance. If you can't access those at scale, you can still ship oil. But you ship it like a black market operation. That means higher costs, more risk, more leakage. That's where the shadow fleet enters. Once a large share of Russian seaborne crude rides on vessels operating outside mainstream Western service networks, you don't just have sanctions evasion, you have a parallel logistics ecosystem. That ecosystem becomes a permanent feature because it's profitable, and anything profitable becomes sticky. Now, zoom out historically. Russia's state model has always been a pipeline from resource rents to political power. Oil and gas revenues finance budget stability, patronage, and military capacity. That's not ideology, that's statecraft. But the catch is this: Russia doesn't just need oil, it needs oil sold at a spread that keeps the budget humming. Russia can survive lower prices if the currency adjusts or if fiscal buffers fill the gap. But when prices fall and discounts widen and costs rise, you get the same barrel generating less usable state power. And Russia's other pillar, gas, has already been structurally damaged by the rupture with Europe. That matters because it removes a second revenue cushion. So the oil crash is not a standalone crisis. It's the second hit in a two-hit combo: gas monetization impaired, oil monetization degraded. Finally, watch the reserves. Russia's sovereign buffers are often treated like an infinite war chest. They aren't. What matters is the liquid portion, the part you can actually spend quickly without selling strategic assets at bad prices. As liquidity tightens, fiscal decisions get uglier, faster. That's the context. A state running on hydrocarbon cash flow, shifting buyers, rising transaction costs, and finite buffers. Now we talk mechanics. Here's the part most coverage gets wrong. Oil isn't a price. Oil is a ladder of prices. Think of crude quality like alcohol. Light, sweet crude is champagne, easy to refine, cleaner, more flexible. Heavy, sour crude is diesel-grade liquor, still valuable, but you need more processing, more equipment, more cost. Russia's flagship export blend tends to trade at a discount versus global benchmarks because of quality and logistics, and sanctions added a second discount, political risk. Now layer in the real machine, the export chain. A barrel leaving Russia doesn't magically become revenue. It must pass through 4 toll booths. First, shipping availability. If mainstream tanker owners and insurers won't touch you, you rely on older vessels, opaque ownership, and higher freight. That's not just inconvenient, it's a structural tax. Second, insurance and compliance. If you want mainstream insurance, you must meet compliance constraints. If you can't or won't, you shift to alternative insurance or self-insurance, both generally more expensive and less trusted, which can limit port access and counterparties. Third, payment settlement. Even if you find a buyer, settlement can be slower, more complex, routed through less liquid currencies or intermediaries. Capital doesn't care about flags. It cares about friction. More friction equals lower netbacks. Fourth, refinery demand. Crude is only valuable if refineries can turn it into products profitably. If refinery margins compress globally, buyers become picky and demand bigger discounts. This is where the so-called price crash turns into a strategic problem. When global conditions weaken, demand slows, inventories rise, buyers don't panic, they negotiate. And Russia, because of sanctions, negotiates from a constrained position. Now add the key mechanism almost nobody explains cleanly. The West's goal is not embargo, it's discount engineering. When Russia's crude trades close to global benchmarks, Russia's fiscal machine breathes easier. When it trades far below, Russia can still export volume, but it's exporting at a haircut, like a forced seller dumping assets. This is why enforcement actions targeting tankers and traders matter. The public framing is punishment. The functional effect is increase uncertainty, raise freight and insurance costs, reduce the pool of buyers willing to touch the cargo without demanding compensation. And there's another hidden lever, time and distance. Before 2022, Russian crude moved into Europe through short routes. Now a larger share goes to Asia on longer voyages. Longer voyages mean more tanker days per barrel. That's a capacity constraint. It's like turning a city bus route into a cross-country trip. You can still move passengers, but you need more buses, more fuel, more maintenance, and you lose schedule flexibility. So when the market tightens or sanctions hit shipping availability, Russia doesn't just lose price. It loses throughput efficiency. And exporters don't die from low price alone. They die when cash conversion slows while expenses and war budgets stay fixed. That's the mechanical reality. Russia's oil is being forced to operate like sanctioned oil elsewhere, movable but discounted, sellable but through middlemen, profitable at times but with a growing sanctions tax. Which sets up the twist. The system designed to weaken Russia also created a parallel market that is quietly reshaping global trade. Here's the paradox. The West tried to cap Russia's revenue without spiking global oil prices, and it succeeded by outsourcing the workaround to everyone it doesn't control. The price cap didn't eliminate Russian exports. It changed who gets paid along the chain. When you push a major exporter out of normal markets, you don't erase the commodity. You create a new set of rent seekers, shadow shippers, trading houses, alternative insurers, and financial intermediaries operating in jurisdictions that don't care about Western compliance as long as the margin is fat enough. So the backfire isn't that Russia wins. The backfire is that a parallel logistics and finance architecture grows stronger, and once it exists, it doesn't just carry Russian oil. It becomes a template for anyone facing Western pressure. That's the strategic consequence. Sanctions become a catalyst for alternative corridors, not because countries suddenly become ideological rebels, but because they see an opportunity to profit from the gap. And the biggest winners, quietly, are the buyers. India and China didn't become Russia's customers out of sympathy. They became customers because Russia arrived as a motivated seller with limited alternatives. This is what multipolarity looks like in practice. Not speeches at summits, but refinery managers looking at a spreadsheet and realizing discounted barrels can lift margins, then using that leverage to demand better terms. And it gets even better for them. Once crude flows into one country, refined products can flow out to global markets. The molecule gets laundered by transformation. A barrel isn't a barrel anymore. It's diesel, jet fuel, naphtha, products that can enter markets in different ways depending on rules. The sanctions regime becomes a maze where smart actors monetize arbitrage. Now, the second backfire, Europe's diesel reality. Europe reduced direct reliance on Russian crude and products, but global product markets are interconnected. When Russian flows reroute, the pattern of refining and product exports reroutes too, sometimes producing fragile balances, especially in middle distillates like diesel. Longer routes and tighter refining capacity make the whole system more sensitive to disruptions. Third backfire, the enforcement dilemma. When Russian crude weakens toward cap levels, more mainstream shipping can re-enter because compliance risk drops. The market can oscillate between shadow and semi-legit, depending on price, making enforcement a moving target. So what's the irony? The West designed a pressure system that keeps oil flowing but money constrained. It partly works, but it also normalizes a world where Western infrastructure is optional for commodity trade. And once commodity trade can route around you, the power of your sanctions declines over time. Meanwhile, Russia adapts. But adaptation is not free. Every workaround is a toll, and that toll is the hidden story behind the oil crash. So the twist is this. Sanctions didn't remove Russian oil. They repriced geopolitical risk into the barrel and redistributed profits to middlemen and buyers. And that takes us to the part most people actually feel. What this means for your inflation, your savings, and your future energy costs. Now, let's make it personal, because this isn't about Russia in isolation. This is about how energy price structure bleeds into your life like a slow leak in a tire. If Russia's barrels are discounted and rerouted, you might assume that should make global energy cheaper. Sometimes it does, briefly, but the deeper effect is more dangerous: volatility and fragmentation. A unified market gives you predictable pricing. A fractured market gives you sudden spikes when logistics break, sanctions tighten, wars flare, or shipping rates jump. And volatility is what hits households, not average prices. Here's why. Energy is the mother input. Every product you buy has an energy footprint: manufacturing, shipping, packaging, retail. When energy markets become unstable, businesses don't charge less when oil drops. They protect margins. They raise prices faster than they cut them. That's not conspiracy. That's cash flow survival. Inflation expectations get sticky. When people sense instability, they demand higher wages, companies lock in higher prices, and central banks hesitate. This is how energy volatility turns into monetary policy problems, not because oil is just in CPI, but because oil is embedded in everything. Your retirement is exposed through the cost of capital. Energy shocks influence inflation, inflation influences interest rates, and rates reprice everything: mortgages, corporate debt, government borrowing. If rates stay higher for longer because inflation stays unpredictable, the economy becomes brittle. More defaults, weaker demand, slower growth. Gas prices are political theater, but diesel is the economy. Gasoline is what voters watch. Diesel is what supply chains run on. If diesel balances tighten because routes are longer and refining capacity is constrained, transport costs rise and stay elevated. This quietly lifts the floor under prices across the economy. And here's the darker point. The Russia oil crash narrative invites complacency. People hear crash and think relief. But if the crash reflects structural strain, discounts widening, shipping constraints, enforcement tightening, then the next phase is not guaranteed cheap energy. The next phase can be supply disruptions, because distressed systems break. Shadow fleets have accidents. Insurance disputes strand cargo. Sanction waves remove vessels. Wars hit infrastructure. And when the market is already fragmented, those shocks transmit faster. Also watch the second-order effects. If Russia's fiscal position tightens, it has incentives to behave in ways that keep revenue up, pressing for coordinated production restraint, seeking premium markets, leveraging disruptions that lift prices. Fiscal pressure can translate into risk behavior. So what does this mean for you in the next year? Treat energy not as a commodity chart, but as a regime variable, a factor that shapes inflation persistence, rates, and trade stability. If energy stays politically weaponized, your cost of living doesn't need a dramatic spike to hurt you. It just needs a higher floor and fewer predictable declines. This isn't about cheering for cheap oil. It's about recognizing a world where the oil market is becoming less efficient, and inefficiency is always paid for by the consumer at the end of the chain. And the chain ends with you. Which brings us to the real conclusion. The order that made energy boring is dissolving. Here's what's actually changing. The world is moving from a single integrated commodity system, priced, insured, financed, and arbitrated through largely Western institutions, into a patchwork of semi-connected markets, each with its own rules, risks, and middlemen. Russia's oil crash, in that context, is not a tragedy. It's a signal. It signals that energy power is no longer just who has reserves. Energy power is who controls the conversion layer. Shipping, insurance, settlement, refining access, and legal legitimacy. And that's the part people underestimate. The empire is not the oil field. The empire is the spreadsheet that turns crude into spendable cash. Russia is learning that lesson the hard way. It can still move barrels, but each barrel is now carrying a sanctions surcharge, a logistics premium, and a dependency discount. Russia hasn't been removed from the market. It's been repositioned inside it, like a supplier forced to sell through a hostile distribution network. And the West is learning its own lesson. Financial coercion works best when you're the only system. The moment you force parallel systems into existence, you may win the battle, but you train the world for the next war. Over the next 6 to 12 months, watch 3 pressure points. First, enforcement intensity. More vessel and trader designations can change freight economics overnight. Second, Asian buyer discipline. If major buyers sense Russia is cornered, they push harder on price, and Russia's netbacks compress even if global benchmarks rise. Third, buffer burn. Wars don't pause when revenues dip. Once buffers become politically sensitive, the state starts seeking revenue through risk. So the correct mental model isn't, will oil go back up? It's this. We are entering an era where energy is traded through competing pipelines of legitimacy, and the cost of that competition is volatility. In a fragmented world, the price you pay isn't just at the pump. It's in your inflation rate, your interest rate, and the stability of the system you assumed was permanent. Because the real crash isn't the price of Russian oil. The real crash is the illusion that energy markets are neutral.